What's up, you guys? It's Jenessa Schreuder with the Danny Howell team, back again with another video. After being in real estate for 3 years, I've realized there's a lot of misinformation out there. It is so disheartening to hear people my age or maybe slightly older say that they will never be able to own a home like their parents did. Today, I wanted to clarify some common real estate myths that I've heard since I've joined. Myth number 1. Looking at homes is the very first step to buying a home. This is a common mistake. Looking at homes can be super fun and exciting, but your very first step is to get with a lender to get pre-approved. There are a lot of variables that get taken into account when looking at getting pre-approved. Some of the main components that your lenders are going to look at are your credit score, your debt to income ratio, and if you have the sufficient funds ready to go. The last thing I would want to do is show you a home that you fall in love with before getting your pre-approval, just to realize that you're not quite ready. There are plenty of great lenders that I can get you connected with to start the process. Myth number 2. I can't afford to have an agent help me buy a house. Most people don't know how real estate agents are paid. Some of you may be surprised to hear that the seller actually pays both the listing agent and the buyer's agent. The only fee that my team will charge is a flat fee of $395 at closing to cover our amazing admin that helps us out with the transactions and audits our paperwork. Myth number 3. I don't need to shop for a mortgage rate. They're all the same. This is completely false. Although the Fed sets the federal rates, there are plenty of programs that lenders can provide. Like any big purchase, you've got to comparison shop. Not to mention, closing costs and other fees may vary from lender to lender. Myth number 4. I will never be able to save 20% for my down payment. You do not need 20% to buy a home. Depending on what kind of loan program you choose, you could put as little as 3% down. And for veterans, you could put as little as 0. This is a very common misconception because some people want to avoid paying PMI. PMI is short for private mortgage insurance. This is a monthly fee attached to your mortgage to protect your lender in case you were to stop making payments. However, if you did choose to put down only 3% at closing, once you reach 20% of your principal amount, your PMI will drop off. Myth number 5. I'm just gonna wait until the market crashes. If I had $1 for every time I've heard this, I would be a millionaire. I don't know where exactly this is coming from. My only guess could be the trauma from 2008. But if you look at the data, there are many reasons why this is not projected to happen. Mortgage lending standards are much more tight now than they were back in 2008. Demand is still high, and quite frankly, we have low inventory. Back then, we had an influx of inventory and not as much demand. Not to mention, the job market is still strong and foreclosure rates are still low. Bottom line is, we are not in a housing bubble. Home values will continue to rise and people will continue to buy and sell real estate. I hope this cleared up a couple things for you. If you have any additional questions, feel free to leave it in the comments or just shoot me a DM. Thank you so much for watching, and I'll see you in the next video.